we're going to go ahead and get into the next part. Okay, so we've been talking about the different things we can do to try to plan or try to take advantage, or how should I say this better, mitigate some of what we think is coming. And all of these strategies are going to work whether or not the tax law changes. It's just going to be that much more valuable if the tax law changes. So one of the things is planned charitable giving. There's a lot of charitable strategies here, and that you can use to benefit not only a charity, but quite frankly, you can benefit your own estate. We're going to go over these 6: bundling, timing gifts, donor advised funds, foundation, appreciated assets, split interest trust, and retirement accounts. Those aren't the only ones, but they're the only ones we have time to cover in a setting like this. So, in general, bundling and timing of gifts. The reason it's beneficial to bundle or time gifts is because you can get a larger upfront tax deduction, and you can get it now, and yet at the same time, you can, as we'll show you in a minute, potentially retain the ability to control those assets for more than 1 year. Because we had the increased standard deduction a couple of years ago, it has limited people's ability to itemize. A lot of people who used to itemize don't itemize now. But if you do a larger lump sum, if you're someone who makes charitable gifts every year, and you kind of front load those all, you can suddenly move into a scenario where you can write them all off in 1 year. So if I'm used to giving $10,000 a year to charity, and I want to give the next 10 years worth today, I have $100,000 I could write off, right? Technically. And depending on how I do it, I can still maybe control the distribution of that money over a period of time. One of the ways I can control it is through something called donor advised funds. So I can make that larger gift now, yet I can control the distribution of the funds to qualified charitable organizations over many years. In fact, I don't even necessarily have to decide what organizations I'm going to give those funds to. I'm just simply moving them outside of my estate, getting my ability to write them off tax-wise, but now I kind of have the ability to reach out there and distribute those funds to charitable organizations as I see fit. Again, we get a larger upfront tax deduction now, and we increase our ability to itemize. And a donor advised fund, think of it this way, kind of, sort of. It's a way to hold, let's just say you hold some mutual funds, and they can even be a money market mutual fund, but you're holding it with a third party, and that third party that money all has to eventually end up in the hands of charitable organizations, but you retain the right to make the recommendation over where they distribute it. And the reason they're in business is because if it's a qualified charitable organization, they tend to follow you. They pretty much follow your recommendation. But technically they have to have discretion to make it work, but they basically never exercise discretion, but they have it. And they let you exercise the discretion. And that is, it's set up that way, and it's very legal and lawful for that reason. Okay, to continue with planned charitable giving, another way is through foundations. One would be a family foundation. So you create your own family foundation for a larger gift, and the benefit is you can continue to control and manage those assets, and at the same time have them distributed in much the same way for use with qualified charities. Or, depending on the nature of the foundation, it could actually do the charitable work itself, but more often than not, a charitable foundation is just a conduit for money to go to other charitable entities. And then there's things like community foundations. So it doesn't have to be a family foundation. It could be the community foundation up the street, in which you provide them maybe a lump sum gift, but you perhaps ask them to distribute it in your name over time. And a lot of times they'll do that because that's what they do, what they're there for, is to help benefit the community, and you're providing a resource to do that. And so, you know, a lot of times you have some input over how quickly those funds are distributed, or maybe even what they're used for. So it gives you an ability to get the money out quickly, so you get the big tax deduction, but have some control or some input over how it's distributed in time. And then another concept in planned charitable giving would be appreciated assets. Most people are familiar with the idea that if I provide something, we talked about capital gains earlier, and what was going to happen with capital gains tax. Well, if I give an appreciated asset to charity, then let's say I give them something that's appreciated at $10,000, but I invested $5,000 in it. Well, I have a $5,000 capital gain, right? But if I give it to them and they get $10,000 because they can sell it, because they don't pay taxes because they're a charity, but it only cost me $5,000 because that's maybe what I put into it. And if I was going to have to pay a 40% capital gains tax, right? I was only going to end up with $6,000 anyway, so at the most it cost me $6,000 to give them a $10,000 gift. Does that make sense? So appreciated assets, and those could be most anything, but the key here is that it's appreciated, because most people, when they make charitable gifts, they give cash. They just write checks. It's easy. But if you're going to turn around and sell something for a capital gain, you're better off to keep the check and give them the appreciated asset. It's a win-win. Planned charitable giving, number 5, split interest trust. And I'm not going to get into a lot of details in these, but for lack of a better term, there are types of trusts that you can use where you can move assets outside of your estate, and you can either retain income off the asset, and then the charity will receive the asset when you pass away, or you can do the opposite. You can move an asset outside of your estate, and you can, the charity will get the income while you're living, and then your beneficiaries will retain the asset when you die. So that would clearly be a really good strategy for something that you expected to appreciate greatly. Maybe a developer develops some property and is going to be getting some income off of it, but the real value is they want to pass that on to their kids, and they don't want to be paying tax on all the appreciation. So what happens is I get a tax deduction today for the actuarial value, or the determined value, what I'd call the present, or depending on if it's a present gift or if they get the future gift, we calculate the value of that, and I get that tax deduction today. And the beauty of it is we're going to use a going rate. So if we say, hey, we're going to use 3 to 4% as appreciation on an asset, I'm going to give the charity some income, and then we're going to assume that it's going to appreciate. Well, what if it appreciates 20% a year because it was a great investment or a great development? Then my kids get that entire highly appreciated asset when I pass away, right? Because it's already outside the estate and they're going to get it. And the charity got the lead income from it. So again, it can be very helpful both for your estate and for charity. So there's some really good split interest type of trusts that benefit both you in the short term from a tax perspective, and your estate in the long run, and also the charity, because it's either going to get an income stream until you die, or it's going to get an asset after you die, depending on which one you want to retain. And I forgot I stuck this in here, so I just explained it, and here it is. But the bottom line is opportunity to claim a full charitable deduction while the charity receives an annuity payout of income, and then the asset goes on after that. And then the remainder trust is just the opposite. And so you can do it either way. It depends what kind of asset you have and whether you need income on it or not. So 2 types of split interest trusts. Also, most people have IRAs or old 401ks or 403bs, they can use an approach to do a QCD, or a qualified charitable distribution. Has anybody ever heard of these? So a qualified charitable distribution would be a scenario where instead of taking my RMD or distribution from my IRA, which adds to my taxable income, and then giving it away so I get to deduct it, the problem with that is what? Is that income, even though I'm deducting it so my income tax evens out, it increases my calculation for things like how much tax I'm going to pay on Social Security, my Medicare premiums, things like that. So there's a lot of ancillary costs to taking that as income and then giving it away. So we have the ability to give it away directly in a trustee-to-trustee transfer directly to the charity, so that you never take possession of it, and it never comes into your possession and is not counted as income. Yet, it does fulfill the required minimum distribution that you're required to take from your IRA. So if you don't need your RMD, there are lots of things you can do with it to help you estate-wise or tax-wise. But one of the things you can do also, if you're charitably inclined, is if you give it away, number one, it was 100% taxable, right? So it's going to save you whatever you to pay the taxes on it. Number two, it is not going to come in on your tax return to boost your costs of things like Social Security taxes or Medicare taxes or anything like that. So it's a really great strategy if you're giving anyway. We also have charitable giving with a multi-year strategy approach. Giving with a multi-year strategy allows you to think forward, and instead of every year going, I want to give 10,000 or I want to do this, I'm going to write a check, right? To kind of plan your giving so that it will be the most impactful. And again, you might find, wow, I write a check for X dollars every year, but now when I thought about it and I planned it over the next 10 years, I all of a sudden can take advantage of what's going on today, tax-wise or income-wise, and I can actually go ahead and put a strategy in place. I've done my next 10 years giving, it's going to come out, but I've done it in a much more tax-efficient manner than I could have if I just waited and did it every year. Currently, you have a high standard deduction, which makes it hard to itemize. The limit on itemized deductions is also going to cap me out eventually. So if I do want to make a large gift at one time and have it work over a number of years, you're probably better off to do it sooner than later, because as soon as this kicks in, then if you give a big gift away and you itemize it, you're still going to be limited to 28%. And if you're in a high income tax bracket, it could come back to haunt you. Obviously, the proposed changes we just talked about, and on income and capital gains. And then last but not least, we're all planning on being here for a long time, but proposed estate tax changes, I think, are one of the biggest things, because none of us are promised tomorrow. And literally, you wake up tomorrow and the entire state taxation has changed. So planning your giving is pretty important. If there's a chance, okay, so number 7, I'm sorry, that was number 6, charitable strategies. Number 7 is estate planning. And if there's a chance you're going to have assets greater than $3.5 million during your lifetime, then at the very least, consider a credit bypass trust. Back when I started, every person we met with, almost, I'm saying that tongue-in-cheek, everybody needed a family trust. Everybody needed it because the odds were they were going to have $650,000 or more. And if as soon as you went over that, you're looking at estate taxes of 40 to 50% back then. So everybody wanted a trust to avoid probate and to avoid estate taxes. Well, as the laws in Ohio changed about probate and how it's addressed, and as the laws and the federal estate tax exemption went up to 11. Now we tell people you don't need a trust for probate if you set your assets up correctly, and for estate tax. You normally need a trust for control, right? For saying, I want to keep my money in my bloodline or whatever, something like that. Or I have maybe someone who's going to receive an inheritance, but I need to help them be wise with it or something like that. So the reasons are totally different. But as these estate rules change again, and as this drops, we're going to see a lot more people going back and saying, hey, 2 years ago, I didn't need a trust because everything was going to avoid probate and estate taxes weren't an issue. Now we wake up, estate taxes are an issue again. So really what it's teaching us is, as this pendulum swings back and forth, our planning really needs to be such that whatever the rules are, our trusts are engineered to adjust to them. In fact, people who did trusts back here and didn't ever revisit them, and then died when the exemption was real high, these were designed to sock everything away in a family trust at the first death, up to the limit. But back then, they never imagined the limit was going to be 11 million. So what happened is if somebody had $3-4 million, the first person died, all the money got socked into the family trust. And the spouse really didn't have money. They had access to income, but they really couldn't take the money out of that trust. It was going to kids. And they're like, why did this happen? Well, because this was designed to fill one of the trusts up to whatever this limit was, whether it was 650, 750, $1 million. And they never dreamed it would be 11. So all these people went, I don't want all, my husband died, I don't want all of our money going into a family trust because I can't do anything I want with it. So that became kind of ugly. So it's just going to reinforce the need for these to be flexible and what we call disclaimable, so that we make them a certain way, but we give the spouse the ability to disclaim things so that we can avoid everything going into the trust. But anyway, if you think it might be greater than 3.5, a credit bypass trust would make sense. And again, if it sounds like a big number, it's about 1.2 million in today's dollars. So it's really not as much as it sounds like, assuming you live 30 more years. Another thing is, if you think there's a chance you'll have assets greater than 3.5 million, consider removing assets from your taxable estate in order to avoid taxation on future growth. How you do that that's the devil's in the details, and not everybody wants to give up the control, because as soon as you remove them from your estate, you're going to give something up. There's a lot of different scenarios, but there's something you're going to give up if you remove it from your estate. People come in all the time and say, I want to protect my money from a nursing home, and so can I put it all in a trust? And I go, well, yeah, and it'll be protected, but then it's not yours anymore. Or I can put it in a trust and it won't be protected, right? There's kinds of trusts. So what's funny is, you can't have your cake and eat it too. So you have to understand what you're giving up and whether you're willing to. Some of the ways that you can remove assets from your taxable estate, we'll talk about 5 of them real quickly. One is outright gifts. If I'm going to give an outright gift, I want to make sure I'm choosing the right asset, and that's cost basis management. Do I give a highly appreciated asset? Do I give a not so highly appreciated asset? And that's going to be affected a lot by whether I get a step up in basis. If I'm 85, 90 years old, and I have a huge capital gain, and I die with the law as it is, that capital gain went away, right? So I wouldn't want to sell that or give something else away. On the other hand, if they change the rule, and I was hanging on to that, now all of a sudden, oh, they're not going to get a step up. That's going to change my strategy. Annual gifts. Everyone can give $15,000 a year, most people know this, to anyone they wish. So in theory, I could give $15,000 to everyone in this room, and there's no limit as long as each of you don't get more than $15,000, right? I can give it to 100 people if I want. And my wife and I together could give $30,000 to anybody. Is everybody following? So if my wife and I wanted to give gifts to, say, a child and a spouse, we could give 60. in a year, right? Because we can each give 15 each. But what most people don't realize is I also have, for the time being, a lifetime exemption in which I can give 11 million plus to anybody I want. So I'm not really limited to 15 years. I could give anybody I want up to $11,580,000 over my lifetime. I can do it all in one day, no gift taxes whatsoever. There may be gains. They're going to take my basis with them, so there's capital gains there. But I can give this away tomorrow, right? I can give it away tomorrow. But now I gave it away. So a lot of people, I run into a lot of people who are given these $15,000 gifts because they're like, oh, I got this asset and I'm just trying to, and I go, well, you can just write a check for the whole thing. Well, no, I'll have gift taxes. No, all it means is you have to complete a gift tax return. Not taxable. You just have to say, I gave it to somebody. So that's kind of nice if you have substantial assets. Now, why would you do that? If you might not need it in your lifetime, if I give away $1 million now and it grows to be worth $5, and then I die, they get all $5, free and clear. But if it grows in my state to be worth $5, and then I die, and the limit's 3.5, now they're going to have to pay estate taxes, right? Does that make sense? So getting it out, and I don't have to give it outright. I could put it in a trust and hold it for them till down the road. But the point is, it's out of my estate. Other ways, did you guys follow that? Was I clear or not really? Does it kind of make sense? Okay. So gifts to minor children, there's numerous ways you can do it. You can do it in a trust, and then that way you have a trustee managing that asset for them. You can also use something like a 529 plan. The good news about 529 plan is you're helping pay for education. The bad news is it needs to go to education, right? So if they decide they want to use it for a wedding or a house down payment, not as good. You can do it, but there's penalties, right? So it's not as attractive. The other thing people don't realize is that I can give up to 5 years worth of 529 money. I can fund it at once. So if I have a substantial asset, I want to get outside of my estate, that's a pretty easy way to do it. And if my child doesn't use, or whoever it is, the 529, the nice thing about a 529 is you can change the beneficiary's name at any time. So I could make it a daughter and a son and a daughter and a son, and then if they don't use it, I could make it a grandkid. So it can keep on going, but once it's in a 529, you kind of want to use it for education. But it can be, or if they don't use it, could put a niece or my wife wants to go back to school, she can use it. So you can change those beneficiaries at any time. Makes it pretty flexible. And then lastly is an UTMA gift. The good news about an UTMA gift is there's still a custodian. If I want to give a young person a gift, I've got a custodian over it. The downside is when they become of age, it's their money. And they can do whatever they darn well want with it. So you have to be okay with that. So these are just some ideas of ways to get money out of your estate in the form of a gift, if you were so inclined.
John, I just have, on the lifetime exemption, do you expect there to be a clawback provision if they lower it to 3.5 million?
My opinion is no, if you do it before they do it. I don't believe that will happen. If you think about it, if I give away $10 million today, and then you change the law tomorrow, I think I'm going to win that case every day. But I'm not the government, so I can't tell you for sure. But I would say as long as you get it given away, you're okay. They may, a lot of times when tax rules work in our favor, they retroact them to the beginning of the year. But usually when they work against us, they either draw a line in the sand or have it start January of the next year, usually. An ILIT, irrevocable life insurance trust. So this is just giving a gift of a life insurance policy or cash to purchase life insurance in an ILIT, an irrevocable life insurance trust. At the death benefit pays to the ILIT. What you don't want to do is, I have a life insurance policy and it pays to my wife. Now again, if we have $11 million exemption, it's a little bit easier. But especially back here, what people would do is they buy life insurance. First spouse would die. What happens to the proceeds? Yes, it's tax-free, but where does it go? It goes into the spouse's estate. And then what happens? The spouse dies, and now it gets hit with estate taxes. So if we use a life insurance trust, it doesn't land in the estate. The spouse can still use that money, has access to it, but if they, to the extent they don't use that money, then it can go on to the next generation. So, you know, using life insurance is one of the most popular ways, always was, of taking care of estate taxes or capital gains taxes, because it's pretty much the cheapest way to do it, right? I can pay a little bit along the way, and I get a big death benefit at the end, and it offsets the taxes. I suspect that's going to come back into play, and one of the things you can do, like people who don't, so if I leave a $1 million IRA to my kids, and they're both and my child and their spouse are actively employed, and they got to deplete it in 10 years, that's $100,000 a year added income to them on top of their income, and with the new tax rate, that's going to be a problem. So what I could do is I could take my RMDs, and if I don't need it, I could just use my RMDs or a portion of them to buy life insurance, and then when I leave them the asset, the life insurance is a tax-free death benefit that equals what I suspect they'll owe in taxes, right? So I've kind of left them a tax-free asset. It doesn't have to, but that's kind of one of the ideas here. It can pay estate taxes, it can make income in respect of decedent, which is on IRAs and things like that, or it can just create an estate. You spend all your money, say, I want to spend all my money, but I'll leave you a tax-free death benefit, which is better than leaving them an IRA. Split interest trust, GRATs, we talked a little bit about GRATs earlier. So split interest trust, without getting into the details, the bottom line is it's kind of like what I mentioned with regards to the charitable giving, except instead of a charity being the other party of interest, it could be really anyone. It's typically family or a family member or a group of family members into which I want to get something outside of my estate to allow it to grow outside of my estate, and I may or may not need to retain income off of it. So you can use a grantor retained annuity trust. You can also use an intentionally defective irrevocable trust, which can be a type of grantor retained trust or something else. But the bottom line is this means that in addition to getting the asset outside of my estate, instead of the trust paying taxes on it, I'm going to pay tax on it because I'm trying to reduce my estate, right? So there's things you can do over here. Some of these are best used for larger estates and or specifically larger assets, highly appreciating assets, again, that you think to yourself, the sooner I get this outside of my estate if I don't need it, the more the appreciation will go to my beneficiaries. Otherwise, all the appreciation is going to be inside my taxable estate. So those are some split interest trusts, spousal lifetime access trust, a SLAT as well. Very similar, typically designed with obviously your spouse to give them lifetime income off of an asset that you want to leverage to the next generation. Loans to a family. In lieu of gifts, we talked about giving gifts. A low interest rate environment is really attractive because I could gift something to you, either all or in part, and I could say, you know what? I'm not going to gift it to you. I'm going to loan. We're going to do a loan, and you're going to pay me back at a very low interest rate. And guess what? Every year, if I forgive your payment or that part of the loan, that's a gift, right? So what you were going to pay me today in interest on that loan or in principal on that loan, I'm going to forgive you that portion of it, and that's my annual gift to you or part of my lifetime gift. And so what I'm really doing is I'm making a loan, but because of the low interest rate, I should be able to forgive a part of it every year, and suddenly you don't end up paying me back, and you end up getting the asset transferred to you. So it's a really uniquely good time to make to use loans as a way to kind of gift something because of the low interest rate. Generation skipping trusts are exactly what they sound like. Is if I'm going to get hit with a tax at every generation, you know, we stopped talking about it for a while here because you either had $35 million and needed to have this conversation, or you didn't, is people knew. Now we're coming back down to where we're going to be talking about it all the time again. And this is a good example. Well, what if my kids don't need this? Why don't I just bypass them, give it to my grandkids in trust? Because then it won't get hit with 2 generations of estate tax. Great idea. That's called generation skipping. And there are some rules and limits to it, but the person you're giving it to has to be 37 and a half years younger, because then they consider that having skipped a generation. I don't know who came up with 37 and a half. Somebody did. A dynasty trust is, is another way of doing this. It's a trust that essentially exists in perpetuity. So I'm putting my assets in there. Most uber wealthy families, their money's all in dynasty trusts because they don't ever really want to take possession of the money. They just want to have access to it if they need it, right? Because can you imagine if you had crazy amounts of wealth, every time somebody dies, you're going to get hit with an estate tax. Even when it's 11 or 22, if you're worth $100 million, you don't want to be paying 50% every time. So they slap these things in a dynasty trust. They exist in perpetuity, and then each generation has access to income from those trusts. So these are just some concepts, again, that there's lots and lots of ways to get things outside of your estate and get them passing on to future generations. And you can be pretty creative as long as you understand some of the different strategies. And we're big believers that it all has to be part of the same picture. Because what I do in my estate planning has to be secondary to making sure I've got what I need during my lifetime, and it's stable, and it's reliable, and it's predictable, and it's tax efficient. Otherwise, I might wake up someday and go, holy moly, I overdid it. Now they changed some other rule, and now I have to go ask my kids for a loan. We don't want to do that. The bottom line is holistic planning in our mind, it incorporates all this. Yes, it incorporates investments, but as you can see, we just touched on the very tip of the iceberg regarding taxes, and you can see how complicated it can be. And a lot of people, quite frankly, they do their investment planning, they do their retirement, and then they go see an accountant to prepare the taxes every year. And most accountants tend to be historians. That's not a bad thing. That's just what they're doing. They're preparing, and their goal is to save you money this year on your taxes. We're looking at the next 30 years and saying, I care about paying the least amount of taxes over my lifetime, even if it means I might pay a little bit more this year. And a lot of times, it does mean that. If I'm going to do Roth conversion, I'm going to write a check today, right? But once that money's in that Roth, I'm golden, because the IRS is out of my pocket forever. So anyway, holistic planning should incorporate everything. And if you have a group of professionals, they should be working together, or you should be working with someone who's incorporating it all. Now, if you have specific questions, or if you do want to look at your situation, no strings attached, you're welcome. I know Diane, when you're done, you can hand in your evaluations, and then she should be giving you back a time if you want to meet. And at the end of the day, if you, a week from now, you think, oh, something came up and I didn't think about it, I want to call them, you're free to shoot us an email or give us a quick call, and if we can answer your question, we will. That's it. Thank you for coming. I always ask this at the end, be honest. Raise your hand if you learned nothing. Okay, good. The day somebody raises their hand, I'm going to quiz them. I'm just kidding, because